Hello, everybody. Welcome to your... What day is it today? I lost track. It's Thursday. It's one day closer to the weekend. How could I not know what day it is after the meltdown we had today? My name is Merlin Rothfeld. I'm going to be joined today by somebody who's been on the program a couple times in the past, and we're going to do a little bit of a different topic. We're going to talk about, I guess today will be mainly stock splits. We might sprinkle on a little bit of IPOs because there's some things that you can find with recurring repetition that shows up in these markets, and thought, why not have that discussion today with none other than Larry M. Jacobson. Larry, welcome back to the show, my friend.
Thank you, Merlin. It's been a while. I know you've been trying to get me back on here, but we're busy.
Yeah, I know. It's a good thing to be busy. It's good to be busy over there at OTA, so I'm glad I got you on. I'd love to get you on once a month, but I know we've got other people. I got to get Todd Davis on here. I got to get a bunch of people. So thanks for taking the time out today. How you been? Anything new?
No, just been working on all these new initiatives right now. We're really stoked, and it's just been busy getting everything together. So we got a lot of meetings, which is a great thing to have. That's a good problem, and we're just working away, and I'm excited to be a part of this, and exciting times in the market, interesting times in the world, and we're going to see how these two things kind of work together.
All right, well, let's go down that avenue. We had something rather historic happen on Monday. Obviously, that was the final split date for those that had Tesla shares and Apple shares. Actually, it was Friday the week before, but the actual shares would have shown up in your account as of Monday morning. Some people freaking out because they thought they had 4 or 5 times as much money in their account. But there are repeatable patterns. I know this is something that you wanted to talk about today, which is the dynamics of how stock splits work. So what do you want to discuss today with stock splits?
Well, let me give some background, because how this kind of got on my radar was many years ago when Warren Buffett decided to introduce the B shares. And what I came to realize, and we're seeing this happening now throughout the industry, especially at Robinhood or say Charles Schwab, they're starting to introduce fractional shares. So this is the whole new game going on. I like to refer to this as the new kind of video game in trading, where instead of having to go out and buy 100 shares of stock, they'll sell it to you 2-3 shares, or fractionally buying shares. And this is great for people who don't have a lot of money, but I don't see them getting rich anytime soon. And so back in the late 90s, Warren Buffett got wind of the fact that hedge funds were trying to split up his A shares, which at the time were probably somewhere between $100,000 and $200,000 a share, and people could get into those A shares if they were being sold fractionally. And so when you look at it right now, and we talk about this era of splits, usually when they're splitting their stock, they're trying to do one of 3 things. They're either trying to entice a bunch of new traders, in this particular case, not to go out to somebody else and buy it, but they want to be able to sell directly to consumer. And so people who don't have to worry about it can go in there and start buying these shares. But at the same time, you got a bunch of traders out there that don't understand how the markets work. And so when they hear this word stock split, they confuse it, just like you said, that things are cheaper, when in reality it's the same price. The only difference is now, if we're looking at, say, Apple, right, you would have had 4 more shares in the account for every share that you had, but the stock price would have been cut down to about 1/4 of what it was selling at before. And so that third group is there might be the company itself. And this is when Warren Buffett did this again when he did his B shares, because he introduced the B shares back in the late 90s to kind of thwart off other people breaking up his A shares. Mm-hmm. That's kind of when I got involved with Berkshire Hathaway in the late 90s. And then he went further on and split the stock, but he did what was called a reverse split, where he was, anytime you had 1 share, you got, regular stocks, but 50 to 1. I'm thinking Citibank. I'll talk about that in a second. With Warren Buffett, 50 to 1. So for every share that you owned of the B shares, you now own 50 shares. But again, that price would have been reduced down. Right. And so the reason he did that with the B shares was he was interested in the purchase of the railroads. Remember, back then he wanted to own the railroad. And how many people can actually live the life of a monopoly player, right? He actually owns a railroad.
Most of it just end up going to jail. That's a...
Or knowing you'd be one of those hobos who would have the stick with his little bag behind.
Hey, I would buy Baltic and I would charge the highest rent and I'd still win that game.
That's Merlin, you're going straight to jail. So anyway, this whole idea is now, and really kind of happened after, remember 2008, Citibank did a reverse split. I mean, their share price was so low. What they did was they reversed it for every, certain amount of shares you had less shares, which propped up the stock price.
Right.
So there's some manipulation going on here. And so what I thought we talk about is a common mistake that most novices make. Because again, we're really enticed by this idea that we can go out in the marketplace, we can finally buy something cheaper, but are you really buying it cheaper? So I know we have some charts that we wanted to show. I don't know if you want to bring it up.
I will bring up the charts for you, Larry. That's just the kind of team player I am, brother.
Here you go. You are, and so you'll have to walk me through it because I'm not seeing you. I'm just seeing me.
Yeah, I've got your first chart there. So you got the stock split.
Okay, so we're talking about the Apple and the Tesla stock?
Yep.
Okay, so what I want you to take a look at is this did not start Monday. This started as soon as they announced the split. And what most people don't understand, this took me a while to figure out, and I did right around the IPO of Facebook. If you take a look at the chart, and you'll have to read it to me because, again, I don't have it in front of me because I'd sent it to you. I can kind of bring it up. But the idea being, let's just kind of look at that increase since they announced the Apple stock split. Can everybody see how price rallied up? So you were already buying into a higher stock even before the split happened.
Right.
And now what I want you to do is to look at what happened after they announced the split. What did price do? It kept going even higher.
So I'm going to do it for the podcast, Larry. So basically, you're looking at July 30th, guys, is when Apple made that announcement. It was at $96.19, right? So it was sub 100. That was on July 30th. By the time it split, which was the 24th, 28th, somewhere in there of August, you're basically going a month out, and it was at 129. So it already rallied $30. That's a 30% jump in price, 34% to be precise, by the time they actually did the split. So this was all anticipation, and as Larry points out, you can see the run up before. It was down almost at $80 in the month leading up to it.
That's right. And in fact, I'm bringing it up on my screen here so I can kind of take a look as we're talking about it. So the problem that you got to understand is it's not really cheap when it's split. If anything, it's now more expensive than it was, right? And so I just showed what the actual cause and effect was when it closed that day of the split, the 4-to-1 split. And it was already up, as you can see there. Pre-split rally was already up that 34%. And then look what happened. As soon as they announced, boom, went a little bit higher. And what did price do? Started coming down.
What it always does. What it always does.
And the reason is you got a kind of interesting dynamic. And I kind of share this with the students a lot when I say when you look at a chart, everybody out there is looking at the same chart you're looking at. So you got to remember that the institutions, the market makers, people that are kind of controlling the market behind the scenes, they're seeing this price rallying. Now, Merlin, you and I and a bunch of our students, we wouldn't be buying on the way up. We'd be looking for a pullback where it would be cheaper. Right. So right now you had all these people buying into this split, driving it even higher. And then the institutions came in and started driving it lower. And if we look to the right at Tesla, can you start to see the same thing happen with Tesla? So when I have these green lines in here, this is where I'd be more interested in wanting to look. Maybe I can go down a little bit under 400 with Tesla. But you got to imagine there are going to be a bunch of people, and two things will happen. As the market starts to sell off, people are going to go, uh-oh, I bought this at the wrong price. It's not going higher like I thought it would. It's now going lower, and they'll get to a point where they start to panic, and guess what they're going to do? They're going to sell right into the waiting institutions. They're going to look to buy this cheaper and then drive it higher. And if you notice, this has been the predominant pattern of whenever they announce something, there's always this hype, isn't there?
Always.
And as a result, people get all caught up in the euphoria. They want to get this stock. For some reason, they think in their minds it's going to go up. But what I want you to take a look at is, and I know I gave you this next slide if you just want to change to it, let's take a look at the cause and effect that happens here. I don't know if you have that up.
Yep, got it, yep.
Okay, so this was back in 2014 when Apple announced previously that they were doing a 7-to-1 stock split. Again, the stock was about $700. Now this is again adjusted even further now after this 4-to-1 because this is a current monthly chart.
Hey, quit playing tennis with your microphone there, buddy.
Yeah, I'm sorry. I hit it by accident. And so up 32%, same way going into that actual split. And notice what happened. Price went higher and then it started to sell off. Mm-hmm. And look how many months, because this is a monthly chart, it took for people to get back up to that high adjusted right now to around, it looks like 33, 34. And I'm just counting candles here. It looked like it took 1, 2, 3, 4, 5, 6, 7 months to get back to where they purchased it. And that's just getting back to where they bought it, let alone making profits. For almost a year, people were sitting on stock that they overpaid for. And as a result, look what happens. The price came back to an area, it turns out to be just where they first started to split it, and the price then took off.
Yeah.
And so I just started to see this pattern over and over again. And we've heard it with earnings. We see it all the time, which is, buy the hype, sell the news, right? Mm-hmm. Buy the rally, sell the news. And this is no different. You've been hearing this hype about the stock splits, but it wasn't the time to start buying when it split. You wanted to start accumulating before the split. So that way you could just ride it up. And even if it pulls back, like we see here on the chart, you're still technically in profit.
Well, I'm gonna share a platform here. You guys, hopefully, you'll see this one. This is the same chart that Larry's talking about, but I think it might paint a clearer picture. And part of what I want you to get out of this is there are certain things in the markets that usually work, that usually happen in a specific way, and the thing that happened is with Apple. So let me show you the most recent data. Here's your Apple. You guys can see the run up, right? There's 2 vertical blue lines on your screen, and that is the first one is where they made the announcements of the 4-to-1 stock split. It rallied 46% in under a month, and then all of a sudden started cratering from that point. And it's predictable when they make these announcements because people hear about stock split and there's this neophyte novice mentality that says, "Oh, I'm going to have 4 times as much Apple." Yes, you're going to have 4 times as many shares of Apple at 1/4 of the cost. It's not like you make a ton of money. And I will tell you guys, I'm sure this happened to some of you. I saw a comment in here. Mike says, Fidelity actually did show more money in my account until they got their algo correct. Yeah, a lot of these firms are making that mistake. They don't actually report, they don't update their database yet. So all of a sudden, you had, 100 shares of Tesla at $2,300. And now you're supposed to have 5 shares at $2,300. You think you're rich. No, that's not the way it works. It gapped, divide by 5. So look at this chart here. The chart's telling because this is what just happened. And I just want you guys to see this fairly predictable reaction I see with almost every stock split. Not a reverse, but a normal split. If it's a reverse split, it's going to keep going down. They're reverse splitting it because it's a garbage company normally. Anyway, let me scroll you back to the last time that Apple split. For those that don't know, that was back in 2014. So bear with me as I go way, way, way back. And we will look at 2014. And I want you to see if that picture looks as... Oh, shoot. Does this picture look the same to you guys? The 2 vertical blue lines here. Notice that the day they announced it was April 23rd. Big gap up. It ran for a month. It ran a total of 26% to the upside. And then the day that they announced that they made the actual split, that day, it just started to fall. And it fell for about 2 weeks straight. So, when we look forward and we look at something like Apple right now, let me see if I can bring that one up again. Look at Apple's current price point. Do you think that that's going to continue? I do. And that's why I like what Larry was showing you was... don't get caught in the hype and want to continue to buy this one right now, but maybe there are some levels coming up, like he's got mapped out on this previous chart here, where, there's a zone on Apple that's pretty decent between 112 and 109. That may be that buy point in. Of course, you have to take that risk yourself and calculate out what that risk would be for you, but, jumping on this one's pretty crazy. As you know, I can't trade Apple. I almost bought puts on Tesla. I just thought it's a little too crazy for me, and I didn't. But anybody who bought some puts on Tesla was significantly rewarded. And this is the pattern that's normal. The date of the announcement, huge run up for probably the next month. The day the split actually happens, it's profit taking and things start to sell off. So next time you hear a big company name, keep that one in the back of your head. There might be some opportunity with that one.
Absolutely. And then, what we talked about, Merlin, was even if it does split, you have to have the right mentality of how you want to deal with these stocks, because there's 2 different camps, right? We could be traders where we're doing for more active income and we're trading the chart.
Yep.
And there's more long-term investing. And so as you and I used to talk about all the time on Power Trading Radio, it's very, very different mindset when we're looking at it. And when I hear people say value investing in different things, it means different things to different people. Yes, I can get it cheaper, but when you're looking at it, sure, there's always this opportunity where we can find a stock that might be trading a little bit below or maybe toward fair value, but it may not be a stock that you're going to want to own for the next 5 to 10 years like a Warren Buffett would do. He's looking at this as a total company with fundamentals and a whole bunch of other things. And one of the things you and I did, I know that we talked about, if you want to go there, up to you, because I can't see you, is the fact that we can look at the fundamentals right now of both Apple and Tesla. And I know we were looking at Tesla right now.
You're jumping the gun, Larry. You're jumping the gun. Look,
That's
guys, look at Larry trying to steer the show. Hey, host your own show, buddy.
Can't see what you do.
All right, so let me go to the question that was actually, so Larry and I did talk about this earlier. There was a question that came through, and that was from Wilson. It says, Larry, since you're a fundamentals guy, what's your thoughts on Tesla? So Larry and I actually took a little time to look at some of the fundamentals out there, and I thought maybe that might be fun to share with people because you guys remember last week there were some comments coming through the chat. Don Fron was one of them, and actually he'll be on the show tomorrow. We looked at the average S&P PE ratio, 15 to 18. It's a little bit higher than that right now. Amazon, surprisingly, a 26 PE ratio. That's pretty good. It's not really overvalued. And Tesla, as of Monday, was 1,300 PE ratio. I mean, that's ridiculous valuation. And the question is it warranted? When you look at fundamentals like Larry likes to look at, is there a place in the portfolio for something like Tesla? So now we can go down that road, Larry.
Well, let's just kind of talk about so everyone knows what you meant by that. 1,300 PE means there's somebody out there right now willing to pay $1,300 for every $1 of earnings. And so what's interesting when you look at these two companies, I look at them vastly different. And Apple, that's $1 trillion company, very established, strong product model, good fulfillment process. And then there's Tesla. And what Merlin and I did was we looked at, are they including SpaceX in this, or is it just purely the car company? And if I look at an Apple right now, it's like the same dilemma we had after the year 2000, right? We had all this run up on speculation of stocks and companies that had no earnings, but were being propped up because that's the thing people wanted to do. So I look at Apple a little bit differently than I look at Tesla, and you'll hear this in the numbers. So let's kind of, I don't know where you want to drive. I'm going to kind of bring it on my screen.
You just tell me where to go, and you just walk me through it, and I'll do it.
Let's go to Yahoo Finance.
You're supposed to go, Yahoo! Sorry, too soon? Right.
Yeah, well, it's tough when I can't see the banter. Half the fun is bantering at you.
Next time you can just come to my house. I have another desk right there and another camera, so we'll do it from here.
We've done the Hass Masks show before, so we can do that again.
People are still waiting for the sock puppets, Larry. They want the sock puppets.
I'm telling you, Merlin. Now, see, Merlin didn't want to go there. I wanted to do a security show with you, and we were going to wear the ski mask with the mustache coming out. Because that guy's awesome. So if we're looking at Yahoo Finance, and let's bring up Tesla, because I think it's good to show that one, and then we can compare it. So TSLA, right? And you go to the balance sheet. That's really what I'm looking at here. I'm very interested to know under financials, and I know Merlin's probably doing the same thing.
Yep, I'm driving for you. So you said financials, balance sheet. Okay, got it.
And I'm on mine. And we scroll down, and we go under liabilities and stockholder equity. Okay, and then we're looking at total stockholder equity. Well, we can see here that there's been a little bit of a bump now in terms of return to their shareholders. For a long time, between 16 and 18, it kind of stayed around the same area. We got a little bit of a bump, but if we scroll down a little bit lower, because this is the interesting thing to look at, you got a visual of this, you'll see down at the bottom, they've been generating higher revenues year over year, but look at their earnings. Their earnings have been terrible. So what I want to do, and in Merlin, I don't know if you want to just kind of write these numbers down.
Let me just read this. So if you guys want to go annually, their annual 2019 financials showed $24.6 billion in revenue and $862 million loss on earnings. I mean, that's a pretty remarkable swing. Now, here's what's interesting is if you look at the quarterlies have been looking pretty good. So, their previous quarter, Q2 of 2020, $6.04 billion in revenue, and they made $104 million. So this is part of the reason it feels like there's that turning of the corner. But guys, the valuation is still stratospheric. I mean, it's off the charts.
Yeah, and this is where I think the numbers will really make people go, whoa. So I don't know if you have a way of just drawing on a pad. You can write these numbers down for them. So I just want to give you some perspective. So the two things that I really like to look at as kind of a very quick analysis, and we'll do Tesla first, is something called return on equities. Return on assets. And that's really measuring how effective the management is on generating revenue for the company. And if we were to say that Tesla shut its door today, didn't sell another car, didn't make any money, right now they could probably sustain on their money right now, their revenues, for about 1 year. Think about that. If they went completely bust today and they couldn't sell another car, they can live on the money they have internally for 1 year. Now, the sector that they're in is 2.44 years, and the S&P overall could sustain for about 5.57 years. So right now, Tesla, in terms of its management effectiveness, is underperforming not only the S&P, but its own sector right now. And that number, when you look at it, you want that number to be as high as possible. And right now, Tesla as a company is low. Now, as far as total debt to equity and how much debt they have, we want this number to be as low as possible. Well, right now, Tesla's debt is about 0.98. The sector is 0.57, and the S&P is 0.78. So right now, Tesla has more debt than the entire S&P. Think about that, right? So we got to look at this as, like I was sharing with Merlin today, it amazes me how news works, right? Everybody, I was listening to KNX, that's the station I listen to when I'm driving into work to get the news before the market opens, and they were doing cartwheels today because only 800,000 people applied for unemployment. It was under 1 million.
Yep.
I don't know about you guys, but 800,000 is still a lot of people, right? So they're kind of making this whole thing, woo, but you know what? The market was just ready. And we might not see this as the ultimate crash, but we're hearing these little bits and pieces from the Federal Reserve presidents. We're hearing it on the news. The economy is not doing as well as it can be doing. And as a result, there's only so much the market can sustain when it's not really earning what it can earn anymore.
Yeah.
And so what we've been able to see here, and I was actually talking to Todd Davis about this morning, if you really look at the VIX right now, we're starting to see, right, changes in the VIX. We're starting to see in the option premium, the difference between the bid and ask prices, they're starting to get wide again. The last time I saw them this wide was at the end of February, beginning of March. And one thing that you and I talk about all the time is if you look historically, the worst month, believe it or not, for trading has been September.
Yep.
And so this just might be time, and this has become the most challenging month for most people to know what to do if they don't have rules, because they're scratching their head and everybody's saying it, but no one's really acknowledging the fact, how can the economy be getting worse, but the stock market keeps getting better?
Yeah.
Okay, so yeah, we're all kind of miffed on that one at this point, I would think.
Guys, it's interesting. If you go back, so Larry said it was the most challenging month. I would make a correction myself there. I wouldn't say it's the most challenging month. It's the only month that, if you go back to the 1950s through till 2020, September is the only month with a negative rate of return. Right there, it should speak volumes for you. And I wanted to talk about that on Monday's show, but there was just so much stuff that we covered. Those are the types of patterns that you kind of want to play on. And we think about Black Monday, we think about Black Tuesday, there's Black Thursday. Those all happen in October, so most people think October is this demon month, right? Oh, October sucks. October is actually a pretty good returning month, barring those catastrophic days. September is overall negative. If you go back to 1928 through 2020, you were looking at an average of negative 1% for the month of September. So she already had a negative bias for September. Given the way that these markets have been so volatile, I have a feeling we'll be way more than 1% down for the month of September. I mean, shoot, we had that today. You're looking at 5% for the NASDAQ in one day. But it's about time, right? Because
Right.
Facebook, Amazon, Apple, Google, Tesla. It's unbelievable. 100% plus rate of return in 6 months. That's just ridiculous.
Well, and you also have to look at how it plays into the overall index as well, too. I mean, you've got those companies in the S&P and in the NASDAQ. So right now, they're more heavily weighted in the NASDAQ. So if those stocks tend to turn over right now, we're going to see the NASDAQ come down hard and the S&P is going to follow. And if you look at the Russell had a down day too, but it didn't feel as bad because it doesn't have that exposure to some of these bigger tech companies you're talking about. So as far as Tesla from the numbers right now, I would say it's an average stock. It wouldn't be a stock I'd be looking in my portfolio to want to add for a longer term right now, but you could trade it. I mean, you're just looking to trade, supply and demand and being able to take advantage when the prices get very high and look to be adding to your position when it gets lower. I'm
actually bringing it up right now because obviously today Tesla finished over 400, which was great. But I believe it just broke down below the 400 mark. So that line you had in your chart there earlier, Larry, I'm going to bring that one back up for the viewers. Where was that? It was 333 to 313 as a demand zone on that bad boy. Hey, you know what? The way that Tesla's been going, you might be able to see that. I don't know if it'll hit it tomorrow, but it could very easily get back down to those levels and possibly even go back to the origin of that big move on the announcement of the split. I mean, guys, one of my colleagues, Dave, sent me an article, which, sorry, Dave, I didn't read it, but he paraphrased it for me, and he's like, look, if you take the valuation of a company and put it per vehicle, like price per vehicle, Toyota would be about $20,000 per vehicle. Tesla would be about $800,000 per vehicle. I'm not paying $800,000 for a Tesla, I'll tell you that.
Right. And we've seen this before with certain stocks, and then all of a sudden it finds its base. But imagine right now, I mean, you're looking at somebody going, ooh, I couldn't get in, but now look at the price now. You're paying about $410, and now you're looking at it in current that you're down to almost under 400. Yeah, we could see a retest there. And, that's a lot better than buying it up around 500 and then seeing it drop down to about 350. I mean, you're a novice trader. You're not having a happy day.
No, definitely not. I'm going to show one chart here for the viewers. Larry, I'm bringing up the chart of Amazon. As you guys know, Amazon, no surprise to anybody in this audience, has had probably one of the more stellar runs, and understandably so, because as this whole COVID thing hit, everyone is buying stuff online, and it's just so much easier. 118% on 170 days. And you know what, folks? They have not announced a stock split. Hint, hint, hint. I mean, and look, they're at $3,300. Even if they did a 10-to-1, it would still be a $338 stock. So keep in mind, to me, this is the next one that's going to announce a split, and you'll probably see a huge rally up in Amazon. It's just ridiculous. So wait for a little pullback here. I think Amazon might be the next nice buyer.
Yep. Now, can I flip and just talk a little bit about Apple for comparison?
Yep.
So right now, that return on asset, if you remember, for Tesla was about $1.03, right?
Yep.
One year. Apple is 17.75. So Apple doesn't have to sell another computer, anything, and they could live off their own money, their own cash for another almost 18 years.
18 years.
Think about crazy. 18 years, right? And here's the other crazy part. Apple is at 17.75, S&P is at 5.57, and their industry is at 2.27. So they are just crushing their industry or sector right now. But you want to have a leader in there, and I can kind of understand that because they're almost $1 trillion company. But we keep hearing these things about Tesla, and in fairness, they have done an amazing job with SpaceX. I think that's where a lot of Elon's money is going to come from at this point. I'm not so sure from a long-term perspective yet about Tesla. But as far as debt, if you recall, I told you the total debt to equity was 0.98 for Tesla. It's 1.3 for Apple. Wow. So their debt is just slightly higher, right, than Tesla's. And they're $1 trillion company.
But you know why, Larry? This is interesting because right now, corporations, it's cheaper for them to go and raise capital and bring on debt at 2%, 3% than it would be to maybe go out and acquire it some other way. So when we look at somebody like Apple, they're sitting on $93 billion in cash. For those of us who are like struggling with, I got $5,000 in my checking or savings account, they've got $93 billion. That's a lot of zeros out there.
That's like Warren Buffett's, worth.
Crazy. They just got it in cash sitting there. But, I wanted to make that point because when we hear debt, you instinctively think, oh, this is bad for the company. They shouldn't have debt. And I disagree. There's good debt and bad debt. And I think Apple is astute enough to say, hey, you know what? We can take on debt. We can make those debt payment obligations, but this debt is so cheap. And if we lock in things for 10, 15, 20 years at this rate, we'll really prosper down the road because the cost of capital will be higher then. So I think Apple is probably doing a better, more strategic approach here. I think that the debt numbers for Tesla, they're not getting the 2 or 3%, right? I think that the bonds for Tesla are getting something like 8 or 9%. Well, that's a little bit harder to make that debt obligation 9% versus, let's say, 3%. So just want to throw that out there.
No, it's great points. And you're right. And the fact that they're having to give up that much in interest payments also tells you that they're treating it more like junk than they are even corporate bonds, right? I mean, they're getting expensive again. So you got to realize if you're investing in bonds with them or preferred stock and they default, right, you're going to be in some trouble at this point. So again, it all comes down to your perspective. And again, with Apple, believe it or not, I'm not there yet as far as, this is a great price to be buying it for maybe longer term. I'd like to see this come down. I think you will see it come down more. And that's really the great opportunity of being able to sit there with it. And even during these times of uncertainty like 2008, if the stock is a great stock, it will come down, but it's not going to be as catastrophic. And the one thing that I find a lot of people doing when they hear these terms, value investing and bargain hunting, you might be buying a lousy stock cheaper. Right?
Yeah.
It's not going to be a great stock. You want to find a stock, if you're going to buy it for a longer term, that it has potential to do much better. And that's kind of what you and I started to talk about. God, it's 5 years ago, believe it or not.
Yeah.
And how these two things were very different.
Well, especially with the Apple stock and Apple company, I think your risk of them collapsing is probably pretty slim. I mean, they got a foothold in so many different markets, and they'll stick around for a while. Tesla. This is an interesting point that you brought up earlier when we were talking. It's like, do you think that Tesla's just going to all of a sudden be the only car producer in the world? And do you think that Toyota and Chevy and General Motors and BMW are not going to go, wow, there's massive demand for electric vehicles. They already have tons of the infrastructure already in place. It seems to me that they could spin up very, very quickly and all of a sudden put a tremendous amount of pressure on Tesla. So, right now I think that this goes back to some of the stuff we saw back in the late 90s, which is that .com. And I think a lot of people may be putting a little too much, pardon the pun, too much stock in what Tesla can deliver. Now, there's one thing, because I know I got some lovers of Tesla here, and I want to throw this out there too. You got to remember that Tesla is not just the car company. If they can do what Elon Musk is talking about with the battery, then that's a whole different ballgame, right? Then this valuation could be cheap for Tesla if all of a sudden can you imagine, Larry, all of a sudden every home is now built with Tesla panels because it's just so much cheap. I mean, standard construction materials here in California because of the sun. I mean, it could happen, but that's a long shot, and I think it's a little too risky to be jumping on now. I like your buy point lower around 333.
Yeah, we'll just see how it plays out. So those are really the key things. And IPOs actually work the same way, but a little tougher too, because you got to remember when you're dealing with an IPO, if we want to talk about that real quickly, same type of thesis here that you're going to see this run up. And usually when they first announce it, it never opens where they first list it. And that's because unless we're friends with bankers or somebody who's got an inside as a private investor, remember what they're waiting for, that any type of white knight comes in, or people that want to be, venture capitalists, they're putting in capital with the idea that you're going to go public someday and really bolster up their investments. So you got to think about it. When that initial public offering comes out, and I'll never forget, because I was talking to some people years ago about Facebook, which was one of the worst IPOs, remember, that they ever announced. They had to actually shut it down on the NASDAQ. People were like, why aren't you buying Facebook right now? It was like at 45, 50, 60. And someone said, well, where would you buy it? I said, 25. And they laughed at me. Oh, it'll never go down there. Sure it won't. You got to remember that the institutions also can't go in and do certain things for a period of time because of the IPO. So they can't just go in and start selling it like they can stock splits. And so I've seen that happen. If you go back and look at Alibaba, back when, you'll see it. It just tended to happen, right? And we started to see rally, boom, shuts down. Then eventually it gets to the price where it makes more sense. and it tends to go higher. So you've got to remember that when you're looking at stock splits, you're looking at IPOs, you got to ask yourself two questions. One, is this a company I want to be invested in? You know, do I like what they do, as opposed to it just could be the next hot thing? And two, you've got to be willing to be a little bit patient, knowing that banks are not going to be buying and chasing a rally in price. They're going to wait for price to get to where they want to sell it. They'll drive it down, and then they're going to buy it back at a much cheaper price.
Yep. Great question from Tom. No, sorry, Sorry, Tom. You sent in a couple great questions. Naum says, why would Apple take on more debt when their $93 billion is worthless? Well, it's still $93 billion, even if you think the U.S. dollar is going to be getting devalued more and more each day. Here's the reason why. Apple could go out and use that $93 billion and be acquiring companies with it right now, but then they might stretch themselves a little too thin. It's this emergency blanket that they keep in their reserves. That 93 isn't just sitting in cash. It's in investments, right? They will be putting that into the market somewhere. They might be actually buying other securities with that. That's up to them. But when you're using debt, as long as you have enough capital to pay the debt obligations, and because interest rates are so low, it's easy for them. So when this market craters, and you notice I said when, because it is going to happen. It'll happen over the course of time. There's boom bust cycles. We have massive bull rallies, massive big sell-offs. When the big crash comes, Apple will be sitting there on $93+ billion worth of cash and can now go around the industry and go, oh, we'll buy you, we'll buy you, we'll buy you, because we have all this cash. So they're keeping, in my opinion, I'm sure some people might think differently, but I think that they're keeping that to have that ability that when the crap finally hits the fan, or they want to just make an acquisition, they can without touching any of their equity.
Yeah, I'll give you a great example. Prior to the year 2008, there was no such thing as Berkshire Hathaway Properties. Right? And hedge funds were buying up all the depressed property back when. And so they owned it. And so another thing we got to think about at some point with the housing prices, they're going to go, hey, I made a good profit. Now let's start dumping it off on the public again. And if the economy turns and people can't afford their homes, I mean, we're looking right now in the state of California where they had to put an eviction, law in place right now to February that if you're renting, they can't evict you. There's a bunch of stuff going on because imagine all of a sudden if people start losing their homes again, what kind of catastrophe will that create when once again we see the housing market potentially pop? Yep. And it's not to say that it won't. And we're seeing bigger cities right now having some issues because people are starting to look to move out of the big cities.
Richard brings up a good point. He says interest on bonds is a write-off for their bottom line. Yeah, there's also a write-off for that. I mean, so it's a strategic move. They can pretty much get free money depending on how they cook the books there. Tom, can I teach you how Nikola merged into an existing company? Not today. That's a complicated subject. I don't think that would be more confusing to anybody, but I'll see if I maybe can do special on that one at some point. Larry, what else you got on your plate? I know you're working a lot of initiatives. You've been working with me on the options on demand. I actually got a nice email about some of the on-demand courses, so thank you those of you who are watching your on-demand courses at OTA. Go for it. You should have, what do we have done? We've got core strategy done. We have futures done on demand. We have strategic investor just being released on demand, and options part 1 should be ready here soon, and then we'll be working on parts 2.
Yeah, no, I mean, the great thing about this is people have a lot of time right now. And so one of the things that we're trying to do is create a self-paced environment for some people that just right now with all this downtime, people can be educating themselves. I always like to say education appreciates, possessions depreciate. So if you can use this time to better yourself and being able to invest in yourself to be able to learn new things, it's a win-win. And so right now we're really pushing to get these on-demand classes out so people can go whenever they want to right now. Great videos, labs, everything's kind of included. And as you said, we've been working really hard on that. And if I can just tilt my hat a bit, you and I in a few weeks are going to get back together to do an election protection show. Yeah. And it's hard to believe that's been 4 years ago when you and I did that show going into the 2016 election.
That was a fun one. Well, that won't be on this show, guys. That'll be through Online Trading Academy, so I'll let you know more about that when it starts to get closer. You got any classes going on, or are you just too busy on content?
Yeah, no, what I've been doing mostly is working a lot on content. I will be doing XLTs. I'm doing a Clubhouse session now that I love doing on Fridays for our mastermind students. And so I just been kind of popping in and out of different places. But yeah, I'm kind of getting everything ready and geared. Obviously, the world's going to look different.
Yeah.
Even if the COVID thing ends, this world is getting different, and we're going to have to keep being able to deliver our content and help our students with their trading. And one of the things we just launched, which has been phenomenal, is something called GPS, which is guided practice and sessions. And every morning at 5 a.m., you can be right there with instructors as they take you through the markets. You're doing still your Monday market outlook. I'm loving it. We're just getting very, very innovative right now in how we want to deliver our content in a world where we're going more and more online.
Yeah, awesome. All right, Larry. Well, again, thank you so much. I know you're a busy man. I want to take it. I'm sure your phone's ringing off the hook over there. So I appreciate you taking some time on the program. I look forward to our election special, but I have a feeling you'll be on here before that election special.
Hopefully that will be the case, and it's great to see you. You're doing a fantastic job, Merlin.
All right, buddy. Thank you. Take care.
Okay, bye.
Bye. Guys, that was Larry M. Jacobson giving a little bit of insights into IPOs and stock splits. I love stock splits just because there's that predictable reaction, which I showed you. And I think it's really, really important that when we hear about the next one, just know that there's a normal predictable action, which is a really aggressive run-up until the date of the split. Then usually the day of the split the actual split date, like we saw with Apple and Tesla, right? It was as of record as of Friday evening. Those shares now showed up Monday morning. A lot of people unloading. We had 1 day of up, and then it's just been falling ever since. So I think there's something to be learned from that one. Before I go to, I don't even think I updated the economic calendar. I may have. Let me see here. But I want to go to this one from, this is from Tom. I love this. Tom, you sent in some great emails, and I apologize if you didn't want me to share this one, but I'm sharing it anyway because it's damn good. Guys, this is trading in a nutshell. This is what it all boils down to. It's this. He says, I got stopped out of my FNGU ETN yesterday at 227, and it went back up to 245 by the close. It was in an account that takes 48 hours to settle. So you can imagine what's going on here. Tom's kicking himself. He's like, son of a, I got out at 227, and it rallied to 245. I mean, that's 18 points extra would have had in my pocket. I mean, God, drive me nuts. That's 8%. And, you go and you go to bed that night and you're all pissed off and kicking yourself and, you're all grumpy and moody. And then what happened? Well, he says, came back the next day. Fast forward 1 day, FNGU drops to 195. Now I love being stopped out and not being allowed to get back in due to the settling period. I'm hoping to start easing back in tomorrow if it shows signs of reversing, looking at 190, 181, 165 as demand or resistance. And then there's a little exclamation point in there. I gotta learn to love the game even when I hate this game. That, my friends, is trading in a nutshell. And that's why I love stops, actually. Don't ever get upset that it stopped you out and you could have, should have, would have made money. It's always great when it just goes ripping further against you. I actually love it when it does. You get, let's say you bought something at $50 and you said my stop loss is 48, and you get out at 48 and you're like, dang it, I know it's gonna go up. You look at it a couple weeks later and it's at 25 or 15 or 10. You're like, yeah, thank God for the stop. So thanks for sending that one in, Tom. I appreciate it. You gave me a good chuckle because I've been in that many, many, many times, that situation. All right, what do I got for tomorrow? I think I do have this updated economic announcement one. This is, yes. Obviously, you saw the initial claims numbers today get down to 800,000, which is obviously going to be positive. People should have had an optimism out there because we're down below that 1 million mark. It's still 800,000 initial claims, and that's a lot of people that are out of work. If you look at what's happening for tomorrow, that's September 4th. We have unemployment change for Canada as well as their unemployment rate. You have average hourly earnings for the U.S., non-farm employment change. The two big ones here are going to be non-farm employment change as well as the unemployment rate for the U.S., which is expected to go from 10.2% to 9.8. Judging by the way that we saw initial claims happen and some of the other jobs data, it actually feels like we'll probably get lower than 9.8, which would probably be, it should be positive for the market, but I'm telling you what, there's a lot of potential fear built up in today's action. If you saw that VIX was just jumping and jumping. I mean, we had a pretty nice spike in the VIX today, so. Tom, you're not a famous loser. Come on, it's about sharing your experiences and learning from those, right? I'm sharing all my losing experiences with you too, just to hopefully help you guys get better. All right, and James Taylor, thank you so much for the contribution. I do appreciate that very much. For those of you who want to know about tomorrow's guest, we're going to have Don Fron on the program to wrap up our Friday edition. And then the next week is going to be a little bit of a lighter week, right? We don't have anything going on Monday. I'm going to be taking off on Friday, so you'll have 3 shows next week. The Ambassador of Opportunity, John O'Donnell, will be on the program on Tuesday. We'll see who I get on for Wednesday and Thursday, but so far that's what I got cooking for you. All right, everybody, that's going to do it for me again. James, thank you so much for that. I appreciate it. I will see you guys all tomorrow. Take care.